It's one thing to be able to present financial information to our clients. It's certainly valuable to be able to do that in a way that makes it easy for us to explain to them what it all says. And at the end of the day, it's one thing to be able to show them at the end what it looks like and what they paid for, right? Some of the clients that I've talked to over the years have frankly said, I spend all this money on bookkeeping, I really don't know what I get for it other than being able to file a tax return. And that's where I feel like we've sold a client short if that's the experience they're having. Having a product like Finagraph, as I've mentioned, gives us the ability to provide so much more value. And again, it's one thing to be able to present them with information. It's quite another to be able to have them interact with it. And as you're about to see, when the Finagraph is populated with the data that we've extracted from their accounting software, we're going to be able to click around and show them things. And as I've mentioned earlier, definitions will pop up and solutions will be even provided in cases where you'll see flags that let you know when, for example, a ratio is below the industry average, and you can click on that flag. It'll explain to you why it's being flagged, and you can click over on that ratio, and it will provide potential solutions for how you can improve the thing that's been flagged. So come along with me. Let's take a look and see exactly how Finagraph makes it not only easy to read our financial information, but really easy to understand what it says because of how interactive it is. Let's go see what this looks like. How to interact with your Finagraph. This is the exciting part, right? This is where we get to have some fun and put all this great information to use. So, as I mentioned previously in the course, my favorite way of getting your clients enticed to want to have you using this on their own financial information is to invite them into a private one-on-one session and walk them through it. And as I mentioned, you may want to start off with a sample company file so they don't get freaked out by the fact that you took their financial data and put it into a product without their permission. You know your clients better than I do, so you know which ones would be bothered by that and which ones would be okay with it. Ultimately, you're going to want to ask them, as I mentioned, hey, would you like to see your own information in here? And they'll probably be excited enough by the time you've asked them that question that they're going to say, of course, yes, how do we do that? So once you do that, now you're going to want to really walk them through what's here and what all this stuff means. The first thing I want to highlight, and I'm just kind of working my way from the top down, of course you can view things by month, quarter, or year. You've already seen that. But you might question, I questioned the first time I used this, how accurate is this? Is it really getting my information? Is it accurate? Well, you can determine that on your own by simply clicking here on any of these underscored dates or time references, because when you go into quarter, it's not going to be a month, it's going to be a quarter. But you can click on these, and it takes you right into the financial statements that are sort of standing behind all this. And as you can see a balance sheet and income statement, and it even has a tab for invoices. So you can certainly, and I would encourage you to compare this, make sure you're consistent about the date range you're looking at, but run the same report in QuickBooks or Xero, whichever you're using with Finagraph, and compare it and make sure that the data is exactly the same. When I tested it, it was exactly the same. And then once you've satisfied yourself about that, you can certainly click here where it says back to Finagraph. But the other important thing to note is that you may want to jump back and forth between these two views because you, especially if you're the accounting or bookkeeping professional who's looking to be able to explain this to your clients, then I highly recommend you actually take the time, go through the balance sheet and the income statement, and make sure you understand how these ratios are calculated. Run the calculations yourself. Grab an Excel spreadsheet and do the calculations, because the more you can do things like that, the better position you'll be in to be able to explain this stuff to your clients, and the better you'll understand really what it is that we're looking at here and how the information can be useful. So that's the first thing, and I think it's probably important as the first thing that you know within Finagraph how to get to, like I said, what's standing behind the data that you're looking at in the Finagraph. You've already seen that you can hover your mouse over any of these sort of row headers here, and you'll get a definition of what you're looking at. So again, I would certainly take my time if I were you to go through each of these and again make sure that you understand all of it. We showed you when we talked about how to share this, how aside from using the, or adding them as a user or using the get a shareable link option, you can highlight a section of this and right click and print it. Works really well in Chrome. One of the reasons that my friends at Finagraph themselves recommend using Finagraph in Chrome is the ability that Chrome has to easily print things out. not every browser has great printing features. Chrome actually has extra features that allow you to play with margins and such things. But also it seems that Finagraph has been built specifically to work with Chrome. So as you're seeing how interactive a Finagraph can be, it gets even better, in my opinion, when I can click and drag and highlight a certain region of it and right-click to print it, and you'll see how nicely Chrome will render that to be printed either to a PDF or, God forbid, actually printing it on paper. Please don't do that. Please print it to a PDF to share with your clients. You're also going to see that some of the modules or widgets that are presented in Finagraph have a little icon that you can click on, which when you click on it gives you options for downloading that specific piece in various image file formats as well as PDF. So that if you wanted to, you could actually take pieces of the Finagraph, put it into some sort of a management report, and email it to your client, which, by the way, might be yet another way to get your client interested before they've actually seen Finagraph. Because you send them a report like this with all these visual pieces that make it really easy for them to understand what you're trying to explain to them about the financial health of their company, they're very likely, if they're paying any amount of attention, going to come back to you and say, where are you getting this information from? This is awesome. So go ahead and make sure that you do play around with the interactive features that Finagraph offers, because to me that's what makes it so amazing.
But for the purposes of this lesson, we're focused on sticking with interacting with the Finagraph within Finagraph, not leaving Finagraph. So you've seen what there is to see as far as that stuff goes pretty much for most of this. You can, again, move your mouse over. You can click on anything. Remember that the data that you're looking at when it gives you these pop-ups is based on the most recent period that's shown. And you can do the comparison and say, okay, well, we're at 10.29. We're well above the industry average here. But as I'm going to show you in a couple minutes, there's another benchmark you can use, which would be, because at this point, I don't need to worry about the industry average. And for all I know, it's not even a good industry average if I'm this far ahead of that. But I'd certainly want to now switch this and look at it in terms of how I can set goals for myself. Because if I'm at 10.29 now, maybe I want to get it to 12. This also could be an indication, by the way, that I'm holding on to too much cash, that I could be making better use of my assets, being more efficient about the use of my assets by investing some of that money into fixed assets and other kinds of things. So don't assume just because it's a nice big number that that's necessarily good. Again, that's why it's important to really understand fundamentally what all these things mean so that you can interpret them and use them to provide great guidance to your clients. Over here, make sure you understand these pop-ups tell me my cash declined by $1,500. That's why there's a flag here. And here it declined by a lot, $185,000. Right over here, it's increasing. So these are these little visual cues that let you know these are things you may want to look at and may want to be prepared to explain to a client what's going on and why. Now, as I scroll down, again, here you have your ratios. Understand them, study these definitions, make sure you understand how they're calculated. Go back to the financial statements and do the calculations yourself. Make sure you can come up with the same number that they're showing here. If you can, and you can do that on your own, then that means you have a really good understanding of how this is calculated, which is only going to help. Now let's look down here. Let's look at the cash impact map. And again, we start to see right away why I think this is so powerful, because it lights up in red and I say, okay, that looks bad, but why? Why is it bad, right? It may not be clear. The first long red line is next to inventory days. Move my mouse over and look what it says. If your inventory days was at an industry average, you would have 180,793 more cash. So in other words, it's suggesting my inventory turnover may be slow. Maybe I'm stocking up on too much inventory. Maybe I need to, sell through some inventory and not buy as much. AR days. I would have more cash if I increased my AR days, meaning that I'm slow on collecting. Now, that might be normal for my industry, and even if it is normal, who cares? Maybe this is a good way of getting me fired up to say, I don't care what the industry says. I want to collect it faster because I could have access to more cash faster, and maybe based on that, not have any debt or reduce my debt if I have more cash, right? These are the ways that we want to start thinking about this stuff. Working capital, same thing. And notice once I get down below the ratio tables above, each of these sections has one of these little options. And I've shown you this previously. This means that you can print the chart or you can download different file formats to get these images and drop them into an email and send it off to your client. So anytime you see this, it means that's what you can do. Working capital, sales expense. So again, it's showing you just in a graphic, very visual way what's going on here. So sales, cost of sales, it looks like maybe we're operating at a loss here because the cost of sales looks like it's higher than the sales. And sure enough, the profit is certainly down below, so that seems to be consistent with that thinking. But the point is to look through this, understand what it's telling you so that you can be prepared to explain it to your client and maybe download the image and send it in an email to them in a report with a link, the shareable link, so that you can say to them, hey, look, just a quick pro quo, look at what's going on with your sales and expense trends. And click this link so you can get a look at your own interactive version of this. This is one of my favorites here, the accounts receivable chart, the open invoice concentration. Let's go right to the large chart on this one. Now, when you're looking at this, I'm looking and I'm seeing that a good portion of my accounts receivable, almost half of it, is coming from one customer. Maybe this is skewed. Maybe I know that this is an anomaly, this is an unusual situation, this client placed a particularly large order, and it's really not giving me what I feel is a true picture of what my AR concentration really is. So notice where they are located down here in the legend. I can click on them and they go away and it automatically reconfigures. Now sporting goods is now taking up more than half. Let's get rid of them. So now you can see maybe what looks like a more realistic picture. But notice there's a concentration here of, quote, all others. Let's put these guys back into the mix. And then notice the slider down here. Right now it's configured to show 5 customers, but I can slide this to the right and show more. So it'll be a more detailed chart, which means more to look at. But I love how interactive this is, and I love how in a quick second I can play around with this and get different views and get information that certainly can be useful to me in terms of which customers I might want to call. Because going back to when we were looking at those some of the other information where we said, hey, you know what, we could do better about collecting our receivables. Well, this would help me get a very quick visual look at whom I should be trying to collect from first, right? I want to go for what I call, of course, the lowest hanging fruit. The people who owe us a lot of money, perhaps, although the reason they owe us a lot of money might be that it is a large order. And, you know, again, you have to understand what's going on and who these customers are specifically. Sometimes we work with very big customers and they just can't be pressured to pay sooner. So you skip those and go on to the ones where you feel you do have some leverage such that you can call them and try and increase these ratios, try and increase your accounts receivable turnover so that you can improve cash flow. Improving cash flow, as I said, can often result in a reduction in the debt that you need to carry, which of course reduces interest costs and so on and so forth. I can go on, but you get the idea. Down here we're back to a table and we have an assets table. So this, and again, when you click on it, it gives you the definition of what you're looking at. So this is pretty straightforward. Again, notice that these are hyperlinked, so these will take me back into the financial statements that effectively sit behind all this. Let's go look at, this is the sample from Finagraph. Let's go look at one that's not a sample. Let's say this was your client. I retail online. And let's say we're looking at this. As I mentioned, the first thing I can do is I can say to them, look, the current ratio looks good. That means you have current assets in excess of current liabilities by a factor of almost, well, let's just call it 3.5, right? Which means 3.5 times over, if I needed to, I could satisfy my liabilities. The quick ratio is a little more conservative look at that same picture. It only considers, the immediate liquid assets, cash on hand, basically what you have in the bank, and accounts receivable. In the current ratio, we include more than that in terms of, we include the total current assets, which could include things like inventory. On the quick ratio, we exclude inventory because inventory may or may not be liquid. We may or may not be able to sell it. So this is a more conservative look at the liquidity of the company. So these are the kinds of things you want to look at, understand how it's calculated, understand what it means, and then be prepared to explain it to your client so that when you're going through this live with the client, you could say, hey, client, guess what? This is a pretty good indication that you're in a healthy position in terms of your financial liquidity. If we needed to, we could pay off our debts. And while we're at it, maybe we should look at that. Do we have enough cash on hand to settle some of the debts that we have? These are all indications that everything looks good because it's being compared with the industry average, and compared to the industry average, we look better, which is great. Then we can come over here, though, and see where are the flags. Why is the return on assets flagged? It says right there, it's flagged because it is below the industry average of 23.63%. Well, I might look at that and say, okay, well, who cares? I don't care about the industry average. Right now, we're looking at a NAICS code that is having us get compared with, quote-unquote, all other information services. So, frankly, when I see that, I don't know how relevant or how confident I would be in the relevance of that information. So that's where we want to start thinking about coming over here where it says customize flags. So let's do that. Let's go customize flags. And let's say that if our current ratio, and we can look at them over here, and let's turn on custom flags. We can turn off using industry data at the same time. So if the current ratio is 3.56, then let's say that our goal is to get it to 4. The quick ratio is 2.76, just looking there in the background. Then great, let's see if we can get that to 3.5. Now we look at debt to equity. Debt to equity, and what's cool is notice it gives you the definitions right here. So if as you're going through this you kind of forget what the definition is, no need to cancel and go back. They're smart enough to put this right in here. So we're comparing what we owe. We're comparing essentially what other people have put into the business with what I've put into the business. And think about it from this standpoint. If I'm presenting information to a potential creditor or an investor, what do you think would make them feel better about my company? Do you think they would like to see a situation where I put in more money than others, or where others have put in more money than me? And there's no right or wrong answer here, because I've talked to people who are very proud of the fact that they've built businesses with other people's money. So maybe that's the deal. But if you're looking for somebody to invest in you and they see that your debt to equity is 1.45, which means creditors have put in $1.45 against every dollar that you put in, that might not bode well for them. So again, think about that and make sure you understand these ratios, especially when you're trying to set the goals. Right now, the debt to equity showing on this company is 0.3, which looks pretty good. It's less than 1, right? Less than 1 means I, as the owner, have put in more than the others. So, but again, maybe our goal is to get that down to 0. I want to pay off all my debt and just not have any. Gross margin. Are we looking to increase profitability? Could be that we're right at what we feel is critical mass, so there's no need to increase that. At the same time, it could be that we would like to increase. These guys show a very high gross margin of almost 100%. You can't really get much better than that, and that's because they really have no cost of sales. They sell an informational product, and there's no cost of goods sold. There is some direct cost, but not much. So let's put this in as 100% and say that's going to be our goal. The net margin, again, move your mouse over if you don't understand what that means. What's the difference between the gross profit or the gross margin and the net margin? Right, let's go back here. Gross profit margin determined by dividing gross profit by sales. Net margin, profit margin as a percentage after operating expenses but before taxes. So I may not care about this. To be honest, in a lot of cases, I don't care about what the net margin is. I'm much more interested in the gross. But you can certainly look at this. We have a net margin as of January of 3.92. So let's say that we want to get this up to 5%. ROA, 1.49%. Return on assets. Obviously, we want this to be high. We're comparing income to assets, right? So return on assets is an indicator of how profitable a company is before leverage, and is compared with companies in the same industry determined by dividing profit before taxes by total assets. So how much money, how much income, net income, are we generating with whatever our assets are at any given time? Return on assets. So that's something we want to see increase ideally. So let's put 2%. That's why. 0.05 there. Okay, inventory days. We saw an indication in the sample file where this is something we'd want to increase. And these guys, it's irrelevant because they don't carry inventory. Like I said, they sell an informational product. ROI, return on investment. So that's your net income divided by your equity, right? ROI and related metrics provide a snapshot of profitability adjusted for the size of the investment assets tied up in the enterprise. ROI is often compared to expected or required rates of return on money invested, determined by dividing profit before taxes by equity. So again, take net income divided by equity. That's your ROI. Again, we'd like to see that increase, if anything, over time. We're at 1.93%. I'm looking in the grayed out background there. So let's go 1.93%. Let's just say we want it at 0.02. Let's get that up to 2%. So inventory days, AR days, AP days, let's say I'm not too concerned about. I click Save, and then it's going to reconfigure how my flags are showing up. We're no longer comparing to industry average data. We're now comparing to our goals. So now these are flagged because it's below the user-defined threshold of a value of 4. Below the user-defined threshold of a value of 3.5. So you see how that works? So this is powerful because to me, this is probably much more important than comparing it to any industry average. In fact, I have a philosophy where I compare, running a business to being a swimmer in a swimming competition. If I stop to look in the lanes next to me, I'm going to slow myself down. But if I keep my head straight and focused and keep constantly trying to improve myself, then it won't matter what the rest of the industry is doing. It will only matter that I continually improve myself, and eventually, wherever I'm at with respect to the average, it's only going to get better and better and better. So I would say this is more important to sort of micromanage versus comparing to industry average stuff. You might want to look at the industry averages on a more periodic basis, and that's easily fixed by simply going back into customized flags and changing these options. Check this off to use the industry data and uncheck this so that the custom flags are not enabled anymore. So again, that's pretty much all the ways as of today that you can interact with a Finagraph. The company will be rolling out updates. We will be rolling out additional lessons to show you what those updates are as they come out. But in the meantime, if you haven't already, I encourage you to please get yourself on a free trial of Finagraph, or better yet, just pay for it, because I think it's going to pay for itself many times over with the kind of information that you can use it to provide your clients. And the important thing is to, again, this isn't the sort of product where, and I think we make this mistake a lot in our industry just in terms of the basic financial statements, is we run the reports and we send it to the clients and we say, okay, my job's done here. But if the client doesn't take the time to look at what we're sending them, it really provides no value. And in many cases, even if they do take the time to look, they don't really know what they're looking at, or they may only know a little bit of what they're looking at, so they only look at those things. A lot of my clients over the years, I've noticed, they'll just look at net income. Oh, what's my net income? Great, I'm making money, that's all, I'm done. Right? And that's such a narrow scope in terms of the bigger picture at large. And I think it's critically important for clients to better understand the importance of the rest of the information that's here. And for that matter, they'll see so much more value in what they're paying you for, and you'll be able to provide them with so much more value because you'll be able to give them this kind of information. But the whole key to all of this is reviewing it with them. It's not going to do a whole lot of good if you just send it to them. That's why the best way is to at least send them the shareable link so they can have the opportunity to interact. But I would encourage you to invite them in at least the first time to a one-on-one session, maybe a few times, so you can go through it with them, make sure they understand it thoroughly, and then once you feel you've gotten to that point, then update it once a month, send them the shareable link. That would probably be a great workflow to incorporate onto all of your accounting and bookkeeping clients. As always, I hope that you've gotten something out of this. I hope we had some fun along the way. And if you have any questions at all, and you are an enrolled student at schoolofbookkeeping.com, please take advantage of our answers forum. If you're not an enrolled student, enroll. If you aren't ready to enroll for some reason yet, then go ahead and take advantage of our public forums, and I'm sure somebody will get back to you with answers as quickly as possible. As always, I hope you're having an absolutely fantastic day, and I look forward to seeing you in the next lesson or the next course.
Now that you've seen how to interact with the Finagraph, I think it probably follows pretty logically that you can understand how tremendously valuable this is and what this can offer you in terms of the value that you can offer to your clients using a product like this. I think what makes it even more special is the fact that you've no doubt also noticed by now, having gone through the whole course so far, that how easy Finagraph is to set up and use. It's a product that adds tremendous value with a very short learning curve, and it's something that really will enhance your accounting or bookkeeping practice, in my opinion, if you start really using this with your clients' data. So whether you use it on your own to present information to your clients or you involve your clients more directly in the process, I really believe that this is a product that's going to represent the future of accounting technology, that's going to underscore the way that we're headed in terms of being able to be more analytical and less data entry driven. And it's really going to help you add another service that you can offer your clients, which is going to make you work that much better with your clients going forward. By the way, stick around or stay tuned, because coming up in a few months, Finagraph is going to be releasing a new cash flow module, which will make the product even better. And when they do, we're going to roll out another lesson in this course showing you exactly what this is, how it works, and what it looks like.